Hello everybody and welcome to a quick video where I try to answer the question, is bull market back? And the reason for this question is two pieces of news today are really reminiscent of the boom days of 2021 to me. First of all, we had the first IPO in more than a year, and its stock soared more than 110%. So clearly, some of the doom and gloom of 2022 is gone on that news, and we have another news on a new issue, which is BlackRock, which is filing for a spot Bitcoin ETF. Now we've had Grayscale and other companies try to get an ETF, but none as big as BlackRock. BlackRock is the biggest one. They have a lot of connections. They may actually make it go through and actually get an ETF. So we have two new issues, two new securities that are potentially coming in the stock market, and the market's getting excited. And so the question is there a bull market that is coming back? Well, let us dig a little deeper, right? So yesterday we had the Fed, and we learned that there were no rate hikes, no new rate hikes. But Jay Powell kind of scared everybody by saying that at the end of the year 2023, the committee saw a rate that was 0.5%, 50 basis point higher than it is today. And if you listened to the presser and to everything he said, you could see that he was much more dovish, in my view, at least the way I interpret it. He was much more dovish in the presser than he was in the statement. But, you know, that statement really caught all of the headlines, and we still have some impact of that in the CME number, which is really one of the better numbers to predict what the Fed's going to do. And the Fed is telling us what? They're telling us right now, at least the market pundits are telling us it's going to be 63% chance of a single rate hike coming in July, and then no more rate hike. We wouldn't go past that. So that is clearly a good news, knowing that 67% is not that big of a move up in the probabilities, considering how hawkish, or at least how hawkish the media made that statement of 50 basis points more sound, right? That was by year end, and that was a prediction of where we envision, and financial conditions change all the time. These are going to be updated, and I would not be surprised if this was the last hike. And if this is the last hike, then obviously the market is going to start looking ahead. I like to say it's typically more six months, 12 months-ish, but if you look at analysts, if you follow analysts, and if you follow stocks, you have no choice, unfortunately, but to listen to analysts. You can see they only think 12 months ahead. All of the prediction on all of the stocks that we follow, analysts, their price target, that's all 12 months ahead. And if we're looking 12 months ahead for the Fed and what the Fed's going to do, we can see that 12 months ahead, we are predicting a meaningful drop in interest rates within 12 months if you follow the CME tool. Less accurate over the long run, but also not really accurate at the beginning of a new month. So these numbers will change, and they'll become more and more accurate as the weeks go by, and we may not even get another rate hike. And if we do, that'd be 25 basis points. That wouldn't be much. Remember, the hikes were much starker in the past. And so this is positive news that is putting a vote in for the bull market is back, or at least it's seemingly coming back. If you look at the 10-year, the 10-year is a proxy. It's a good proxy for the cost of corporate debt, for the cost of real estate. And if I was a chart reader, which I'm not, I would argue that there is a little bit of a deflation in the 10-year. It's flattish, if not down. And this is very good news, because this means that the market really doesn't buy that Fed's funds rate is going to stay this high for this long. If you overlay the Fed's funds rate, you can see the increase in the Fed's rate was much starker and much stronger than what we've seen in an increase in the 10-year. So the 10-year, really, the market to me is not buying these promised increases in rates by the end of the year. The market's not buying it. This is slowly coming down. I believe this will come down much more as there's more and more time in between the rate hikes, and as we eventually get into rate drops and lowering the rates, which will inevitably happen in my view. So this is again a vote in favor of yes, the bull market is kind of back. What's another sign? What are some other signs? And I'll preface this by saying that I believe we are in a secular bull market for the decades to come in real terms, i.e., in nominal terms. I meant here in nominal terms, not real terms. In nominal terms, the reason for nominal terms is because, of course, everything is nominated in U.S. dollars, and as the U.S. dollar, as the share of the money stock increases, there's going to be more U.S. dollars out there. And when you look at the denomination in US dollar, the stocks are going to go up. So we're going to be in that bull market, in my view, for a very long time, just because we're seeing monetary melting. We're seeing a decrease in the denominator. That's why I named the channel like that. But the signs right now, there's been some very stark moves in about 6 months, right? So if you look at the year-to-date number, in about 6 months, you're at a doubling on Tesla, a doubling on Sofi, well over a doubling on Palantir, almost a doubling on AMD, almost a tripling on Nvidia, well over a doubling on Open Door. These are all stocks that I've been covering on the channel and that I really enjoyed buying when they were cheaper, right? And I sold Nvidia. I caved. I sold Nvidia. But this is definitely if you are sensitive to anchoring, and we all are in a way. If we anchor the prices to what we remember them as 6 months ago, this is a stark increase, and sometimes it can get a little hard buying a stock. I don't know, in the case of Tesla, for example, it can be hard buying it at 250 when you remember buying it at 160 really not that long ago. And this is true for a lot of these stocks. And so because stocks is a hobby for me, and I enjoy adding to certain positions at certain times, and another way to look at this is that there's always a cheap price out there. There's always going to be an innovative high growth security out there that's going to be well priced. And to me, I see a few of them. I intend to cover them over the next few days now that I'm back from vacation. But some of the deals that I clearly see right now that have not had that stark, sharp run over the past 100 days. Some of these companies that I see is clearly Enphase, Hims, and Mercado Libre. Notice how Hims, for example, is actually up 36%, which anytime in 2022 would have been outstanding, would have been all rejoicing at a 32% increase. But of course, today, poor Hims doesn't look that well because you have stocks that have done more than five times the performance of a company like Hims. In this video, I want to quickly cover Enphase and Hims and tell you why I think, even though it seems there are signs of a bull market coming back, these two stocks I believe are cheap. And I will cover Mercado Libre in another video. More videos are coming now that I am back. So let's get started with Enphase. So Enphase, if you think about it, it's still trading at late 2020 prices. So that's almost 3 years. And the stock price hasn't really moved that much. Noteworthy to say that it's technically still true for Tesla as well, if you look at the long-term chart of Tesla. But we don't have that anchoring issue with Enphase, because we remember Enphase being much more expensive at the beginning of the year. We remember Tesla being much cheaper. In other words, psychologically, buying Enphase right now feels pretty good. At least that's my take, because everything's running and Enphase is kind of not running as fast as the other company. Enphase, really briefly, as far as the number goes, and enterprise value over gross profit is a 13x. Not great, not too bad. It's kind of in the middle of my Friday spreadsheet. The gross profit is 44%, but remember, this is a company that does hardware, so that's excellent for hardware. If it was a company that did software, that'd be bad, right? But for hardware, it's really good. Next 12-month growth is 43%, but of course, one would enter a position in Enphase because of their qualitative analysis of the company. The question is, do you envision solar energy being the next big thing, right? The technology that takes advantage of the fusion in the sky, the fusion in our sky. Every single family home owner out there has enough roof space to capture between 7 and 9 times its energy needs. The energy needs that you need for your cars, that you need for your home, 7 to 9 times. It works just about everywhere. That's why if you live in areas that are warm right now, for example, I live in Texas, you see them popping up everywhere, everywhere, because people notice, oh, wait, that sun coming on my roof is a lot of money. Energy is money. So that's why one would invest in Enphase. That's because you believe in this future of energy independence, or at least what I call energy independence. You are not dependent on the grid anymore for your electricity. You can be self-sufficient with your electricity and produce it. And the benefit of producing your own electricity gets better and better year after year as the utilities have not made the upgrades. The prices of your local utilities keep going up. Yet the prices of the solar energy that you generate by your roof keeps being free year after year once you've done the setup. So why do I like Enphase in the solar space, in the residential solar space? Why do I like Enphase? Well, first of all, they're the leader in marketing right now. I mean, this is a company that I often praise for its technical solution, but as far as their marketing platform goes, they are the best. All installers carry Enphase. Most of them, right? Most of them recommend Enphase. Go to a home and garden show and try to inquire around and see how widespread Enphase is. Enphase is a leading provider of solar systems, and that is true in Europe, that is true in the US, that is true in Australia, and is becoming truer and truer in more and more countries. They have a solution that installers love. Their customers, the customers of Enphase, are installers first and foremost, and Enphase does everything to make the life of these installers easier. They have a software, leads generation, financing. They handle everything, and it's becoming seamless. And so much so that you have installers, for example, who only install Enphase in certain local markets. So that's a big deal. Great marketing. Another thing that I love about Enphase, they will be a major beneficiary of the IRA bill. That's why they are building 6 manufacturing lines in the US to do these inverters. The IRA bill is going to pay 11 cents per kilowatt installed of a micro inverter system. So in other words, each micro inverter Enphase is going to get, per my calculation in prior videos, between 30 and 40 bucks of IRA money every time they manufacture one of these. So they are going to flood the market with all of these because this bumps up their gross margin much, much, much higher than the current 44% gross margin that they have. So major beneficiary of IRA bill, both in the manufacturing of inverters, microinverters, and in the manufacturing of batteries, which they're getting into, and also through their customers who get a tax credit for setting up a solar system. You get a tax credit. Lots of good things going on for Enphase. But at its core, Enphase is a technology company. And if one invests in Enphase, I believe one has to be honest with themselves and also believe that microinverters are the superior technology, which I've been down the solar rabbit holes before. And to me, microinverter is the superior technology. It is much better than string inverters. Oftentimes, if you go see an installer, they say, oh, string inverters have been around for tens and tens of years. They've been around for 50 years. It's a reliable technology. Well, there's a lot of issues with string inverters that microinverters do not have. Just a few of these benefits of microinverters. First of all, they're compliant with the code in most countries now, where there needs to be a way to cut off the power at the panel level so that if there is a fire, if there is anything, you don't get electrocuted during the day because it's a live wire. So they have this built-in cutoff at the panel level, which is very important. And of course, sellers of string inverters have tried to do a patch. They've done this kind of patch, which is the optimizer, in my view. But there's been issues with optimizer. Optimizers are not as good. You have the whole. It's my personal opinion, of course. You have the goal of what? You have 12. The insulation. How does it work? You have 12 panels. 12 microsystems. That's the Enphase way to go. Each panel is its own mini solar setup. But when it comes to string inverters, they are wired in series. And so you have 12 panels with one, and that's one system. So the string inverters, you connect multiple panels in series. So much so that if you have, say, shadow on one panel, the entire string will lose power, and there's multiple other issues like that with string inverters that you don't have in the microinverter setup. And yes, optimizers are getting better, but when you dig deeper, it is my opinion that optimizers are nowhere nearly as good as simply having a microinverter. Remember, string inverters, they're bulky, they're heavy, they have transformers in them, right? While microinverters, they hash and electronically. The conversion of a current is done electronically as opposed to being done quote unquote mechanically. So it's a different technology. That's why the warranty, for example, is twice as long on microinverters compared to string inverters, because microinverters is electronics. Anyways, there's other benefits: individual assessment of your plant panels, redundancy. If you have an issue with a panel, one panel die, you still have 11 panels to go. That's not really true of string inverters. You need to have someone to come and service. I put this ironically, but that's true. That's a consideration. They do not break the back of installers like string systems. If you've ever worked in the solar industry, string inverters can get really heavy to set up. And the fact that a microinverter just fits into the palm of your hand, it's quite small, that's something that the installers really love. Actually, if you follow Enphase, you will know that they change their battery system to also make it light to installers, so that installers have an easier life setting up these very heavy things in any environment. And so Enphase is all about trying to make life easier for installers. They're also easily expandable, upgradable. Let's say you're a household, you have no electric car right now, you still have 2 brand new gas cars. 10 years down the road, you get an electric car. Of course, you want to have free electricity at home to charge at home like you would 95% of the time. You can do that with Enphase. You can upgrade as your family grows with Enphase. You cannot do that with string inverters, or it's much more complicated. Microinverters have other benefits. They are easier to manufacture. They follow the cost curves of other manufacturing giants with flex manufacturing. They follow the cost curves of a lot of electronics manufacturing as opposed to the industrial manufacturing. It's sort of like string inverters. Think of them like an appliance. A microinverter, think of it like a chip, or at least that's the way I think about it. You can manufacture these microinverters so much faster than you can manufacture a string inverters, when you need to have a lot of batches and a lot of testing, etc. They're much faster to set up. They don't have transformers. It is a major benefit. And microinverters, and that's the future vision that one I believe has to believe in when they invest in Enphase, they can be wired intelligently together and managed with one app. And it doesn't matter if you have 20, 30 microinverters or 5, it's all managed with the app. And with your app, you can decide, okay, well, I want to use my energy right now. I want to charge my battery. I want to charge my car. You can manage everything seamlessly with one app. And so they reach a lot of economies of scale with that one app that they have. So these are all of the reasons why I love Enphase. This is especially the reason why I prefer Enphase over, say, SolarEdge. Even though I'm fully aware that SolarEdge has a good performance, technologically, I prefer the microinverter technology, which is why I prefer Enphase. Just a personal preference. If you look at the top performers in the stock market of the past 10 years, you will find Enphase, Tesla, SolarEdge, and Nvidia, just to give you an idea. So these companies are very powerful. Moving on to Hims. So Hims is a company that I've covered a lot, so I'm not going to spend a lot of time here, but I'm a little bit of a contrarian on Hims. Hims is kind of a company that I call a SaaS company that has nothing to do with SaaS, right? So what is Hims? What do they do? Well, they're a leading, if not the leading, digital pharmacy in the US for minor recurring health needs, is what I'm going to call them. Mostly preventative, mostly early on, younger, healthier people that have small issues. They can go to Hims. They can see a professional, a medical professional, who will discuss, analyze the condition, and then will make a prescription if warranted. And that's why I focus on things like ED or like hair loss treatments. These are things that you need to subscribe to, because it's going to be a long-term treatment. It's recurring, right? If you're losing your hair, one application of finasteride is not enough to get your hair back. You need to do that for years and years and years and years. And the same is true for a lot of ED. Unfortunately, some of these drugs you have to take for life. And so that's what they focus on. But because they're digital, because they operate outside of the insurance system, they can do this more cheaply than copays in most cases. And feel free to do the calculation with your own insurance. They have two warehouses that are mostly automated. One in Columbus, one in Phoenix. Almost automated warehouses, moving a lot of progress on automation, and they can just ship to your door your medication, and that medication is attached to a follow-up with a medical practitioner that will follow up with you, and you can chat with a medical professional. You can get prescribed with them. There's a lot of benefits. It's really the healthcare 2.0. It's the doctor in the pocket. I strongly believe in this. I believe it's a better system. Hims has a lot of agility. They're agile because they're outside of the health insurance system, because they're smaller, because they're lean, but they also have strong avenues for growth. And other things include like women's health, for example. They're very much looking forward to their birth control product, heart health, anxiety, depression, hair loss. There's a lot of different things that they can do. Compounding pharmacy. They have a compounding pharmacy. This leads to differentiation. They can make their own compounds, pharmacy compounds, to match the treatment. So this is a personalized treatment. Let's say someone has depression and they need a depression drug. They can adjust based on the level of depression that that person has. The same is true for ED and their new product called Hard Mints. They customize it to the patient's needs. So that adds differentiation. That adds a little bit of protection from the competition, even though marketing inertia, branding for them adds that difference. They are ahead of the competition, and I believe there will be a few winners in this space, and I believe Hims will be one of them. No investment advice, just my opinion. They have a lot of cross-selling opportunities. That's a big deal for Hims. If you're happy with one issue that they're treating you for, you're likely to go to another issue. And then they're what I call recession-proof. In this case, if it's a say a more personal issue, I don't see people quitting that $30 payment because, I don't know, say they're losing their hair and it's affecting them, and losing their hair becomes psychological. It's linked to depression, anxiety when you go to your job, etc. Well, you can either do nothing, or you can say go with a prescription with a practitioner who will talk to you, follow you, and it's $30 a month, and it's all inclusive. It includes your consultation, it includes your medication, and $30 a month is pretty cheap. I would argue. I mean, a trip to the pharmacy with copays is oftentimes today more expensive than $30. Anyways, what I love about Hims, and I'll conclude with the numbers. The numbers are just like SaaS in my view. 75% gross margin, adjusted EBITDA margins that they've guided over the long term will be 25%, which is really high. If you're into that, if you're more of a value side of Hims, because a lot of value investors actually buy Hims because they look at what's left after everything's been spent, and they're like, this is going to be a cash flow machine. Recurring revenue is 95%, which is very high, and the company is dirt cheap at 2.5x enterprise value over gross profit. I cannot understand why this company is so cheap. I really can't. Like, even if you were to argue, like so many do, there's absolutely no moat whatsoever. Well, I would respond to that. What's a moat? And we could have a conversation about moats and the true definition of a moat, and whether that definition still even holds true in an era of constant and perpetual innovation. But even if you were to argue that, I mean, 2.5 years gross profit, that's the enterprise value. That's way too cheap in my view. This stock has yet to be discovered, I believe. The revenue growth, they've upped their guidance for revenue growth for the next 12 months. They're anticipating 56% revenue growth. Absolutely outstanding in my view. And Hims is a stock that you can still buy under the IPO price. So this is a very inexpensive company. And I'm happy to own it. So anyways, this was not investment advice. This is just entertainment. I'm happy to be back. I hope to have more videos coming now that I'm back. Appreciating all of your likes, all of your subscribes. If you're new, if you've been watching my videos for a while and you're not subscribed, please subscribe. It really motivates me to keep going. The next videos I'm gonna make will be a bit more polished, and I'll do more deep dives on some of these companies that I find cheap right now. Thank you so much for watching. Not investment advice. Have a great day.